Let's take a look at Chapter 6. It's about risk and return, and some of the topics we'll talk about are right here. It's a little bit more different type of a topic than some of the previous chapters. So they always show us this slide at the beginning of every chapter. And so we're down here talking about the cost of equity. And that's really what this chapter is mostly about. And so they want us to kind of understand investment returns, measuring the return on investment. They can be historical or prospective. Prospective means what I think will happen. Historical is what has happened. We can express a return based on dollars and a percent, whatever we want to do. So just a small example is, I have an investment of $1,000. After a year, I sold it for $1,060. Obviously, I made $60 on the investment. If I take 60 divided by 1,000, it means 6% on the investment. So that's the two ways to measure that. Investment risk is the exposure to the chance of earning less than what we expected to have happen. The greater the chance of return, far below the expected return, the greater the risk. So a lot of this chapter is about how to measure risk. Because obviously you buy an investment with an expectation, but it doesn't mean it's going to happen. So what's the risk of that happening or not happening? So just some examples. And the way you do this is you assign probabilities. Now, we're not going to get into how you necessarily assign the probabilities. We don't have to worry about that. But just kind of know this is kind of the way you would do it. You say, okay, there's a 10% probability of a 14% return, a 10% probability of a 26% positive return, and so on. So I've got about 5 categories of probabilities with 5 different returns. So if that's what I think is going to happen, and you can do computer software modeling and things like that to help you get to that point, you can chart that. So basically, you're looking at the distribution of the returns. You're going, obviously, the large distribution is right in the middle. I've got a 40% chance of making 6%. I've got roughly a 20% chance of 16% positive, 20% chance of 4% negative, and so on. And then you can do this to kind of show how that looks on a graph. And you can kind of go, here's my distributions of possibilities, with the strongest possibility being right in the middle right here. Okay. And then to calculate this, you can do this formula right here. So they call this the R hat. This is what I expect to happen. So R hat is the caret symbol. They call it R hat. Because I just take that table here, and I just do a bunch of multiplying and adding. So 10% times 1 point times 14%, 0.2 times 4%. Add those all up, and I get to 6%. Okay, so I expect this to be at 6%, but knowing that it may not happen. So then they show us another option right here, and so I've got this kind of bluish purple line and the yellow line, and they say which is riskier and why. Well, the blue one has more risk because it's a much steeper curve, and the yellow one doesn't have as much. So we talk about risk and standard deviation. And standalone risk is the risk of each asset held by itself, kind of in a vacuum, not measured against other assets that we may own or other investments that we may own. And we measure that using standard deviation, which measures the dispersion of the possible outcomes for a single asset. So for a single asset, standalone risk is the standard deviation. And so we can measure that. And so we can look at the standard deviation of a bond's return for the next year. And so this is some possibilities here. And we get 10.95%. And investments with bigger standard deviations have more risk. So the higher the deviation, the higher the risk. Higher deviation doesn't mean we should say, no, I won't do this investment. It just means with greater risk means I need greater compensation. So if I'm okay taking a greater risk because I get greater compensation, that's okay, right? Now, if you're building a portfolio of investments, you probably don't want all high-risk investments, right? You kind of want a mix of high risk, low risk, and some things in between. So most portfolios are built on more than one stock because that reduces risk, okay? And that's what this slide's trying to tell us, that we can reduce risk by having more than one stock. Okay, every time we add a stock to a portfolio, we are reducing risk. Okay, so just kind of keep that in mind. So this slide tells us that. Now, no matter what, I have risk. So if I have a stock portfolio, I automatically have risk. Okay, now there's market risk, which I can never diversify out of, and there's what they call company-specific risk, which is diversifiable. So, for example, if I only bought stocks of oil companies, maybe I had 20 oil company stocks, that's not really diversifying because I still have that company-specific diversifiable risk. So I put all my investment into one industry, right? So that's what you wouldn't do. Sure, I'd have one oil stock. I'd have a tech stock, an auto manufacturer, an airline, a public utility. The list goes on. I'd have a diversified portfolio of different industries, different companies, to reduce that to basically diversify out of having too much exposure to any one particular industry or company. Okay, but market risk is just the risk of being in the market no matter what, and I can never diversify away from that. And the more stocks I own, right, the less portfolio risk I have, I still have my market risk. And that's what they're trying to tell us in so many words with some of these slides right here. But this slide's the best one for telling you that. So standalone risk is your market risk plus your diversifiable risk. And market risk is that part of the security standalone risk that can never be eliminated. So firm-specific or diversifiable risk is that part of security standalone risk that can be eliminated by having diversification, by having multiple companies in my portfolio. So conclusions then, as more stocks are added, each new stock reduces reduces risk on the portfolio, but at some point you kind of get to that diminishing return period. So if we come back to here, this kind of mentions at about 20 stocks to 40 stocks, somewhere in that neighborhood, that diversification goes down dramatically. From 0 to 10, there's a strong drop in the curve. 10 to 20, there's still a drop in the curve, but from 20 to 40, that drop is pretty small. It doesn't really happen very much. That's kind of what they're telling us. So, basically what they're saying is 20 stocks should be a pretty good diversified portfolio. Okay. So can investors holding one stock earn a return commensurate with its risk? Probably not. You're taking on too much risk, right? You're taking on the risk of the market plus the risk of that individual stock. So there's more risk if you own just one stock. So, excuse me. So how do you measure that? And that's the question, is how do you measure it? It's called the CAPM. CAPM stands for the Capital Asset Pricing Model. That's how you measure the risk of one particular stock. They're going to walk us through a whole bunch of complicated stuff to get us there. So just kind of bear with me a little bit here. So they're going to kind of walk us through the mechanics of the formula. So WI is the percent of the portfolio invested in a stock. That's the weight of that investment in stock I. The standard deviation symbol here is the deviation of the market. And PIM is the correlation between the stock and the market. Okay. And so what we're trying to figure out is, what's the correlation between a stock price moving and the market moving? Is there a correlation, yes or no? And how correlated is that? So we're trying to figure out, if the market goes up by 10%, how does one individual stock react to that? Does that stock go up exactly by 10%? Does it go up by more than 10%? Or does it even go down? Or does it go up by something less than 10%? And that's what we're trying to figure out. What's the correlation between one stock and the market over a period of time? Okay. And that's measured by beta. So beta is that correlation. So basically, beta is ultimately the standard deviation of the correlation between a stock price moving and the market moving. Okay. So that's what beta means. It measures risk. Okay. So beta is a measurement of risk. So, as I've mentioned, with greater risk comes greater required return. Okay, so it says here, required return and risk, the general concept. Investors require a return for time. if I'm going to lock up my funds somewhere over a long period of time, I want a return for that because I can't use those funds. If they're tied into something else, I cannot use them. I need a reward for that. R sub RF is what we call the risk-free rate. Generally, it's the 10-year Treasury bond. So I need a return for time, and I need a return for risk. So what they call RPI, and this is for stock I, is the risk premium of a particular stock. Okay, so if I invest in a stock, I want return for time, I want a return for risk. Okay, so CAPM puts those together. They call RPM is called the market risk premium. It's the extra return above the risk-free rate that you require to invest in the market. Because remember, I can always put my money in something risk-free, right? Zero risk, but I get a lower return. So the goal is anything I earn above the risk-free rate is also going to have some risk associated with it. I have to take on more risk to get a higher rate. So the CAPM defines risk premium for a stock. So stock I is the risk premium is the beta of that stock times the market risk premium for that stock. And that's the return on the market minus the risk-free rate. Okay, so that's how you measure the risk premium for any particular stock. So they build what they call the SML, the securities market line. It puts the pieces together and it helps you measure, do I have the right risk and return correlated, that I have an efficient portfolio. So an efficient portfolio is risk and return correlate together and match. Okay, so R sub I, the return I require on stock I, is the risk-free rate plus the market risk premium times the beta of that particular stock. And the beta is measuring the riskiness of that stock. Okay, risk depends on beta. The higher the beta, the riskier the stock. The lower the beta, the less risky is my stock. It's that simple. Okay, so good news is you don't have to calculate beta on stocks. It's available. Yahoo Finance has it available. If you go to any stock in Yahoo Finance and you first pull up that stock, guess what? It's there for you. It's super easy to do. In fact, we'll just do that right now. So I'm just going to go to Yahoo Finance. Very simple. And let's pick a stock. Whoops, I didn't do that quite right. Let me do this bit differently here. This will get it to us better. I did it backwards. So Yahoo Finance, just go to that. At the top of the screen up here, we can just type in simply a stock name. That's all we have to do. Now the slides mentioned IBM as an example, or Dell. It could be any company that's publicly owned. It doesn't matter. Costco is a nice, easy one to use. Very simple company. They just do one thing. So it's always a good example of a company to use for things like this. So I type that in. Costco shows up, and we just go and find the beta right here. 3-year monthly is 0.9. So Yahoo Finance calculates the beta of stocks, and it's saying the 3-year average calculated on a monthly basis is 0.9. Okay, so it's below 1, which means it's less risky than the market. So it's that simple to find the beta. Value line would be another place to look at. Most stocks are between 0.5 and 1.5. Okay, so the securities market line, and we're looking at the steepness of the line. Okay, so obviously we've got a risk-free rate, whatever that is the risk-free rate, and that's horizontal. Okay, and then we're saying is as we take on more risk, okay, we have to, that line's got to move up, higher market risk premium, and so I've got a base case and a higher market risk premium if I take on more risk. So I've got that required return over here matching against higher betas. And that the curve can move, it can shift as interest rates shift and move. Okay, so if the risk-free rate goes up, the line will shift up. So it says here to calculate the weights of a portfolio, with $1.4 million in Blandy and 0.6 in Gormage. So we've got a 2-stock portfolio. The companies are named Blandy and Gormage. And it says, what's the weighting first? So obviously the sum of the two numbers is 2 million. So the W for B, W weight for Blandy, is 70%. And for Gormage, it's 30%. Okay, so that weighting matters. So 70 to B, 30 to G. And then I get my betas for each. Okay, so the beta for Blandy is 0.6. For Gormage, it's actually, a riskier stock. It's 1.3. So Blandy is a safer stock. Beta is well below 1. Gormage, it's well above 1. So I do the weighting times the beta, and I get the beta of my portfolio is 0.81. 0.81. So then I can use the SML to come, kind of figure out what's the required return on that portfolio with the beta of 0.81. So all I do is I plug in that formula, the SML formula, also called the CAPM formula, and I'm saying that I need a return on my portfolio. So RP is the return on my portfolio. The risk-free rate's 4. The beta is 0.81, the number we just got done calculating right here. It told us that the market risk premium is 5. So in this scenario, I need an 8.05% return to properly match risk in return. Okay, and so that's what I do to calculate what this really is. So I can then take the weightings times the returns and figure out, is that the truth? Is that really what it's working out to be? Okay, and so that's kind of what the next portion will show us is looking at two portfolios. Are they hitting where they're supposed to be? So we've got portfolio manager JJ versus portfolio manager CC, and the beta of each portfolio is here, the risk-free rate, the risk premiums, the required returns, the actual returns, and we're trying to figure out, have we overperformed or underperformed our portfolios based on matching the required return against the actual returns. Okay, so that's the purpose of it. You can chart that, and we're supposed to be on the SML. That's kind of the efficient line. So basically what you're saying for CC is he underperformed and JJ overperformed. Okay, so that's the purpose of kind of going through that exercise is you can evaluate a portfolio to see if it was done correctly or not. So intrinsic values and market prices. So at the top here, let's talk about the company, economic environment, and the political climate. Okay. Now, clearly, excuse me, no company controls the economic and political climate. You operate in it, right? You just have to operate in whatever the economic conditions are, the politics are, the regulatory environment, the taxation environment, and so on. Okay. So on the right-hand side in the blue, it's all about perception, which represents the market, right? So the market looks at your company and they go, what's the perception of future cash flows and risk? And that's boiled down into a market price. So all stocks have a perception built into them of what investors think will happen with that company going down the road. Okay, every stock has it. The part of the market price is the perception of what we think will happen. The stock market's based on expectations. Okay, the left-hand side is all the relevant available information about a company, and then looking at unbiased expected cash flows, just saying, what's the true value of this company's cash flows, and what's the true amount of risk? So on the right-hand side is more based on perception. The left-hand side is more based on what are these things based without bias. That equals intrinsic value on the left, market price on the right. The question then is, are they equal? If they're equal, we're in equilibrium. Now, the challenge with any of this type of analysis or evaluation is that it's based on the future, right? To know anything on either side of here, I have to guess the future. Well, we could put 20 people in a room, and all of us would have 20 different guesses about the future, and none of us may be right? So that's the challenge with doing this and estimating the future. So part of being a stock analyst or trying to figure out, should I buy a stock or not, is going through this process of comparing what an individual investor's analysis of the unbiased cash flows, unbiased risk and intrinsic value is compared to the market, and trying to find stocks that are value stocks, that are what you quote unquote on sale, and trying to find stocks that are overvalued that you wouldn't buy, and stocks that are undervalued that you might be more apt to buy. Okay, so market price and intrinsic value, when they're the same, a stock is said to be in equilibrium. Okay, well, how is that established? If the market price is below intrinsic value or expected return is above required return, then we would say the stock is a bargain. And of course, then people would buy that stock. As you have more buyers, the stock price would go up. Okay, and so the opposite occurs with, we kind of flip that arrangement around. Okay. So the efficient market hypothesis, it's all about information. And that's one of the biggest questions with investing is, how efficient is the market, right? So, and the answer is extremely efficient, okay? Because we're in the digital age, we have the internet, we've got cell phones, we can find out anything about everything instantly, right? So the efficient market hypothesis asserts that when new information arrives, prices move quickly, and the new equilibrium will change very quickly, because investment banks and stock brokerage firms have investment analysts looking at mispriced securities and trying to make buy and sell decisions based on that in a heartbeat. New information is available to professional traders in a heartbeat. They're watching stuff all day long while the market's open. And when mispricing occurs, and analysts have billions of dollars to put into buying or selling something and changing the price because of the money they throw at something. Okay, so the implications of that is that stocks are typically in equilibrium, and it's hard to beat the market because it's hard to find stocks that are undervalued and beat the market. Okay, doesn't mean you can't. So that's a theory. Doesn't mean that's true. It's a theory. Okay, it's a hypothesis. Now there's also one called more the weak form. Okay. Current prices that reflect information contained in past prices, so you can't earn excess returns with strategies based on past prices. So, for example, if you invest in stocks that decline below the previous 52-week analysis, that'd be more what they call a technical analysis. You're making a buy and sell based on some technical thing that's happened. I'm only going to buy a stock that's dipped below a 52-week average. Then I'll buy it because I feel like it's underpriced, and I'll buy it based on that without doing a true valuation of what I think the company is actually worth. Most evidence supports weak form EMH because very few trading strategies consistently earn excess of the CAPM prediction. So two exceptions are what they call short momentum and long-term reversals. The chapter spends more time talking about those if you want to look at those. And semi-strong form EMH, current prices already reflect all publicly available information, so you can't earn excess returns with strategies based on information from financial statements or other public sources. So an example strategy, invest in stocks with past 3-year annual earnings greater than 10% and a ratio of R&D to sales greater than 10%. It's called a fundamental analysis. You're just looking at certain trends about sales and R&D and just saying, I'm going to invest in those companies because that's a predictor of future success. There's all kinds of strategies for investing. There's all kinds. Most empirical evidence supports a semi-strong EMH. In fact, it says the vast majority of portfolio managers do not consistently have returns in excess of CAPM predictions. Two exceptions that earn excess returns is invest in small companies that have not yet hit it big, because analysts at the bigger investment companies are not spending a lot of time on those. And also find companies with high what they call book-to-market ratio. So those are two possibilities for beating the market. All information, even inside information, is embedded in stock prices in the strong form EMH theory, and you cannot earn excess returns over that. Okay, it says not true. So it says excess returns cannot be gained by trading on the basis of inside information, which is completely illegal if you didn't know that. So go to jail now. So you cannot use inside information to personally profit. Martha Stewart can tell you all about that. Okay, market bubbles. When prices climb rapidly to heights that were not really seen as a possibility before the run-up. Trading volume may be high, and new investors jump in that may be speculators, and then what happens is the bubble pops and prices drop fairly quickly. We have that happen in the tech area in the late 90s when the internet was first becoming a thing and businesses were figuring out how to use the internet to create businesses and basically monetizing the internet. A lot of crazy money was thrown at tech stocks because of that, and the bubble popped after 9/11 2001, and all those prices in the stock market dropped dramatically because of that. So it typically takes some outside thing for that bubble to pop. Okay, but when that bubble pops, then it's like, oh, look what just happened. You don't necessarily realize you're in the bubble at the time until it pops. You look backwards. Okay, so that's just part of that. So for market efficiency, the bottom line for most stocks, for most of the time, is generally safe to assume the market's reasonably efficient. Okay, with certain things happening occasionally that are not efficient. Many investors that get up trying to beat the market. So you can buy an index fund. It's called an ETF, an exchange-traded fund. If you own an ETF, you get the market. The historical average of the market is 8%. If you look at the last 75 years of the market, the return is 8%. 8% is pretty darn good. Most people would take 8% and go, I'm okay with that. Especially if it's your retirement and you've got many years to retire. 8%, hey, I can take that. Bubbles do occur, though, occasionally, so just kind of keep that in mind. So the CAPM, test of the CAPM, it says have statistical problems that make empirical verification and rejection impossible. Most corporations use the CAPM to determine the required return, which makes sense. So it's what I like about the CAPM is it's easy to understand. It's a way to quantify risk. It's a way to put a number on risk that makes sense that people can understand. That's what I like about it personally. So there are people who are detractors of it. There are people who like it more than others. I would be on the I like it side because, again, it makes it easier to understand. It makes risk easier to understand. It makes risk measurable. But otherwise, it's kind of hard to measure risk. So to me, it's not perfect, but it works pretty good. Okay, so Chapter 6 is a little bit different kind of a chapter. It's more about risk and return, risk and reward. Obviously, if you have questions, feel free to let me know. Thanks.